everyone's kind of focused on the question of recession or no recession, whereas I'm generally finding that some sectors are already deep in recession, whereas other ones are booming. And so you have to kind of answer that question on a sector by sector basis because you have this bigger than normal gap. And so the FOMC meeting and also the Treasury announcements this week were informative. They showed us a slight diversion from the trend we've seen over the past quarter. So the past couple quarters, we've seen larger and larger fiscal deficits, a lot of bond issuance, especially a lot of short duration, like bill issuance, which is really good for liquidity. And we've also seen the Fed get more dovish over time. They kind of finally eased their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table and they kind of delayed any sort of dovish action outright. And so I think we're seeing a little bit of a consolidation with expectations going forward. But I think the overall structural view is still the same, which is that you have relatively tight monetary policy and you have relatively loose fiscal policy.
Lyn Alden's analysis reveals a significant divergence between US fiscal and monetary policies, highlighting tight monetary policy and a larger fiscal deficit. This leads to varied sector performances, with interest rate insensitive industries thriving, while those reliant on short-term debt or equity face challenges. Some sectors may be in a recession-like state, creating a nuanced economic landscape. Recent developments like lighter treasury deficits and a reaffirmed Fed hawkish stance add complexity. The consistent structural view points to a sector-specific recession potential, drawing parallels to the 2001 mild recession. Alden addresses market concerns, emphasizing high valuations of bond proxy equities. Looking forward, caution is advised due to uncertainties in the labor market and liquidity. Alden briefly touches on the evolution of monetary technologies, noting the unique efficiency and decentralization brought by Bitcoin. This concise analysis offers a data-driven understanding of the economic landscape. With that, let's dive into the video. But before that, don't forget to like, share, subscribe, and turn on post notifications for more insights.
I think the description of the macroeconomy is that we've had one of the biggest divergences between fiscal policy and monetary policy in recent memory. And so the general tightness of monetary policy is higher than normal. And at the same time, the looseness of fiscal policy, meaning the size of the deficits, especially relative to the size of the economy, is larger than normal, especially outside of a recession. And so that gap is resulting in sectors performing like their divergence in performance almost couldn't be wider than it has been in history. So, for example, things that are not sensitive to interest rates, at least as much, like profitable tech companies or restaurants and travel, things like that, they're generally doing quite fine. Whereas when you look over at commercial real estate or unprofitable tech companies or things that in general are either highly reliant on issuing equity or highly reliant on kind of shorter moderate term debt, those are the industries that are really struggling, especially if they've also been impacted by changes, things like work from home. And so this everyone's kind of focused on the question of recession or no recession, whereas I'm generally finding that some sectors are already deep in recession, whereas other ones are booming. And so you have to kind of answer that question on a sector by sector basis because you have this bigger than normal gap. And so the FOMC meeting and also the Treasury announcements this week were informative. They showed us a slight diversion from the trend we've seen over the past quarter. So the past couple quarters, we've seen larger and larger fiscal deficits, a lot of bond issuance, especially a lot of short duration, like bill issuance, which is really good for liquidity. And we've also seen the Fed get more dovish over time. They kind of finally eased their hawkishness. But what we saw in this recent week was that the Treasury came in lighter than expected for how much deficits they're expecting to run over this next quarter or two. And we also saw the Fed push back a little bit on the dovish narrative. They kind of reaffirmed some degree of hawkishness. They kind of took March rate cuts off the table and they kind of delayed any sort of dovish action outright. And so I think we're seeing a little bit of a consolidation with expectations going forward. But I think the overall structural view is still the same, which is that you have relatively tight monetary policy and you have relatively loose fiscal policy. I've in the view of either no recession or soft recession, and the way I describe that is kind of sector specific recession, or the type of recession you generally see in emerging markets, which would feel quite different than a recession you get in typical developed markets. So when people think of recession now, they often think of either COVID or they think of the 2008 financial crisis. Whereas, for example, if you go back to the prior recession, you had the 2001 recession, which was obviously very bad for equities given how overvalued they were. But the actual recession itself was quite mild in terms of the unemployment rate, in terms of the GDP contraction, in terms of what other sectors did. It was not a very severe recession by most metrics. And I think that to the extent that we do get a recession, and I admit, in 12 months, there's a lot that can happen. But to the extent that we do get a recession, I would expect it to be more like that 2001 variety, where some of those unemployment statistics and some of those GDP contractions are maybe not as severe as people fear. But that, of course, can still have very big implications. I think one of the biggest concerns in the markets is that a lot of the bond proxy type of equities, so kind of defensive, high quality equities, a lot of them have been bid up to very high valuations. Costco, for example, it's a great company, but the stock is trading at valuations that make it look like they're doing AI or something, right? And so you have
Exactly.
that problem. Yeah, and you have that problem where if you get even a middling economy, let alone a slightly recessionary economy, those valuations are just hard to justify at these very high levels. So I think it's very sector specific out there. My expectations probably somewhere the same, although I admit that I'm not really sure because right now, when you're in inflection points, it's harder to judge. When you have a firm trend in place, it's easier to extrapolate that. So, for example, in early 2022, my view was quite bearish for that year. And we had, purchasing managed indices like PMIs rolling over. We had liquidity indicators rolling over. It was a very bad year for most risk assets. But around kind of either late that year or especially early 2023, I started to inflect more positively, saying I'm kind of flat to up now. As we go into 2024, I'm less bullish on markets in general than I was last year, but I'm not exactly acutely bearish either. And the problem with forecasting the economy is that we're seeing most indicators like PMIs have bottomed, but they're not really showing signs of rolling up yet either. One of the biggest comparisons is probably late 2019, where you had PMIs and other indicators were kind of stabilizing, starting to roll up, and then they got hit by COVID in
Right.
in early next year. So you never really know if a trend's going to continue. I'm seeing divergences where, for example, the labor market is finally starting to show some more notable weakness, you could say.
Hmm.
On the other hand, liquidity indicators are actually starting to show signs of rolling back up. And so I still place this as a pretty high uncertainty environment where I don't really expect the extremes. So I don't really expect a gigantic recession. I don't really expect a raging bull market this year. And my view is unfortunately pretty wide in the middle because we have to be honest when we have kind of high conviction directions and some of those more neutral directions. And the general theme, if I had to summarize it, is that the past 200 years or so, even more in many contexts, almost every monetary friction has been solved by centralization. So, for example, gold is bulky to move around. It's hard to verify that it's gold down to its core. It's basically an expensive and slow proposition to move around and settle gold. So a lot of the monetary technologies for centuries have been around how do we move claims for gold faster than gold itself? And the answer to almost every time was, well, we centralize it. We put it in a third party, and then we just trade, ledger entries with that third party. And then maybe when that third party has a problem, we get an even bigger third party that's under multiple third parties, right? So we keep adding layers and layers of centralization to make it so that not just in a country, but around the world, you can send someone money. And really what you're doing is interacting with a series of centralized ledgers. So for centuries, every single time we ran into a friction, we're like, well, more centralization can make that more efficient. And I think what's interesting about Bitcoin and kind of related technologies like stable coins and things like that, basically the idea of just kind of globalizing this market is it's the first time where you've got greater efficiency, but also better decentralization. And of course, you're relying on other things, like you're relying on a functioning internet or other high bandwidth ways of communication. You're relying on, we had to get certain levels of encryption, certain levels of bandwidth in place before this was possible. But now that this technology is in place, this is the first notable monetary technology that kind of breaks that multi-century trend of more efficiency, but also more centralization.
Thank you for tuning into today's analysis with Lyn Alden. We've covered crucial insights into the current economic landscape, emphasizing the divergence between fiscal and monetary policies. Sectors are experiencing varying performances, with some already in recession-like conditions. Recent FOMC and Treasury announcements indicate a shift in expectations, maintaining a structural view of tight monetary and loose fiscal policies. Alden highlights concerns in high-valued bond proxy equities and expresses caution amidst uncertainties. Looking ahead, the economic forecast remains uncertain, with divergent indicators complicating predictions. Don't forget to subscribe, like this video, and share your thoughts in the comments below.